Hello everyone, my name is John Locke from Locking Your Success, and I'd like to talk to all market neutral traders about the recent events in the stock market and a little bit about trading. But before I do, I would like to remind you that this is a presentation that's given for educational purposes only. I'm not a broker-dealer or a financial advisor, and I'm not making any specific trade recommendations. Also, please be aware that the risk of trading options is substantial, and be aware of all your risks prior to placing any trades. If you'd like more information on me, visit our website at lockingyoursuccess.com and join our mailing list to get the free report, the 7 Secrets to Become a Successful Trader. And also we have a free weekly webinar that you can sign up for while you're there as well. And in general, here is my contact information. Okay, let's get going. We recently had a rapid shift in the market from a relatively low volatility environment to a very high volatility environment. For us, market neutral traders who sell options, this transition from the low volatility to the very high volatility is pretty much the worst thing we can go through. I often tell newer traders that this transition period is where we are most likely to take losses, and this time was no exception. I mean, many students drew down significantly with this recent shift. Some even lost trades, and some lost even more than they planned. Unless, of course, they were trading a bearish butterfly or something, in which case they probably made money. But for a lot of us, we drew down. So for those of you who actually took a loss, or even if you just got spooked by the drawdown, you need to remember that this is just part of the game. If you've been trading for a while, you should realize that nothing crazy happened here. Yes, it's something that hasn't happened in a while, but when you think about it, this was less of a move than 2011. It was less of a move than 2010 in the flash crash, and it was practically nothing compared to 2008. And despite this, I've gotten multiple emails with traders who they're afraid to go back into the market. So I figured I'd just give a talk about this for a few minutes. Now, whether you should go back into the market or not depends on a few things. First is, what is your strategy and how does it react to very high volatility? If you're trading an M3 or a bearish butterfly or a rock or M21 type of trade, I mean, those are trades that were developed in the 2008 crash environment and in 2009. And those environments were multiple times more volatile than it is now. They really don't have any issues trading in high volatility. As a matter of fact, they're very friendly to high volatility and very large price moves after the volatility has risen. They're not so good in the transition if it's an extreme transition. From this point, we are at some of the highest volatility levels that we've seen in, well, since 2011, so in 4 years. Really, from this volatility level to a 2008 volatility level, not a problem. But from an extreme low volatility environment where we were to this volatility, that's where the challenge comes in. Now, since that's already happened, that risk is gone. And personally, I love trading this type of market with those trades. Like I said, I developed the trades in those markets and they withstand extremely large price movements. So for these trades, the opportunity for profits is much greater than it's been in the last 4 years. So from a trading standpoint, with the mentioned trades, all I can say is let the good times roll. That said, if you have not done the proper back testing, the first thing I have to say to you is shame on you. Any strategy that you trade should be thoroughly back tested through multiple market environments, including what we just had here. So shame on you for that. And second, before you enter this market, even if you're trading the M3 bearish butterfly and those types of trades, you should go back and trade the 2011 after the crash, as well as 2010 after the flash crash. And this is going to tell you how your trade is going to react to the price swinging around these very large price swings. And it'll make you feel a lot more comfortable going forward and trading them, and it's also going to help you get used to the new environment, because you do need to trade a little bit differently when the market starts going really quickly. Okay, so but what if you're doing some other type of trading? What if you're not doing an M3 or bearish butterfly? What if you're doing something like condors? Well, in general, if the implied volatility stays high, or starts increasing, condor or even widening butterfly type of strategies that are completely neutral tend to perform very poorly, and I would avoid them. Now, that doesn't mean all condor strategies are going to do poorly. It just means, in general, most condor type of strategies are going to do poorly in a very high volatility environment. The reality is, though, that you should already know how your individual trading strategies perform in these varying environments. And if it performs poorly, don't trade it. And if you don't know, again, you obviously didn't go back and you didn't do your homework when you started trading the strategies and back test markets like mid 2010 and late 2011 to find out. So go ahead back and do that, and then you'll have a very good idea of how you're going to react, and then you can make your decision. Another thing that I'm asked is that since this fast transition from low implied volatility to high implied volatility tends to be a problem, why don't I trade positive vega income strategies like calendars or diagonals when the implied volatility is low, and then switch back to butterflies or something when implied volatility is high? And the answer is quite simple, and that answer is because not all implied volatility is created equal. So let me show you what I mean by that. If we take a look at our analyze graph and we pretend we have some sort of a market neutral position on, and we were to come in here and we were to say, I'm going to hedge my volatility on whatever strategy I have. Maybe it's even a calendar. You're going to add more calendars to. I don't know. We say I'm going to hedge my strategy that I have with 30 calendars here. I'm below the money. I'm negative delta. I am positive vega by 1,806. So if I take a look at this, theoretically, if the market comes down, not only am I going to make money from here, just say it goes down at 1160, not only am I going to make this, I don't know, what's it up, maybe $3,000 or so, but I'm also going to have a volatility increase, maybe 5 points. And I'm going to make like maybe $4,000 or so in this type of position. So you're thinking that, hey, I'm all set with my volatility hedge. So if we were to do this and put this on, and depend on that to happen, and we were to convert our trades here, and move ahead 2 days, right? I'm not up $3,000. I'm barely up $2,000, right? And that's with a ton of delta. So this actually didn't help very much. It didn't even help as much as it displayed without any volatility change. Never mind with a volatility change. So that's not very helpful. But if you're in this position and you're in some kind of your market neutral position and you're sitting here, and let's just say you say, hey, the market's at a support point, which it was. So I'm just going to hold this for a minute, hold this and see how it does into the next day. Well, if we push forward into the end of the day Monday, we had obviously a very hard market down move, and you would expect with an extreme volatility increase, this may have been able to do fairly well. Well, if we take a look at our linearized graph, the position isn't down any money, but it certainly didn't hedge off any kind of vega risk, because we went right through the position and we barely even, and we were very negative delta, and we barely even got up money. And with this push down and this extreme volatility rise, we virtually had no benefit whatsoever from this calendar. Now, you may or may not be surprised by that. I don't know. What ended up happening is when you do a calendar, you have volatility, positive volatility from one month, and you have negative volatility from another month. The negative volatility is what we call the front month, or the month closer to expiration. When the market drops quickly, the rise in the front month volatility is typically much faster and harder than the rise in the back month volatility, and therefore you don't get any profits in your position. Now, interestingly enough, if we go back to Wednesday, and we take this trade out, and we put in 20 1160 butterflies rather than 30 1160 condors, right? And if you look at this, another interesting thing is too, this trade costs less. It has the same potential profit, but it costs less than the calendar. So let's just convert this for a second. So this is what would happen if we put an 1160 butterfly at the same strike, which is negative vega, about the same negative delta. If we take a look here, right, if we take a look here and we look at the trade, right, that's what our calendar looks like. If we take a look at our butterfly, this is what our butterfly looks like. If we superimpose them, right, we have about the same profit potential in our calendar as we do our butterfly, but we actually have less money in the butterfly. But anyway, it's a negative vega position, so this is going to get cream when the market goes down, right? So let's just come in here and we just clear the trades out. And let's just run this forward. We'll run this to Friday. If we run this to Friday, okay, our negative vega position, which is also negative delta, I grant you that. However, so was the calendar, is now up almost $4,000. So you might say, okay, well that was negative delta at the time, significantly negative delta. Well, what happens on Friday? Oh, I'm sorry, on Monday at 1500, the same time frame we were checking our calendar. Right, the market drops its 45 points, we're all the way down the long strike. This is still up $3,000, despite being a negative vega trade. Now, while it's true that if you're trading a calendar, that back month will eventually normalize with the front month, and it should gain value if and only if the market implied volatility stays up. What we're generally concerned about when we have a sharp, fast market down move is that initial hit and the initial profit and loss drop. And the reality is, most of the time, a calendar does not help with that. Sometimes it makes it worse. So this theory of having a positive vega income trade on is not real. If you have a positive vega income trade, you need to remember that that thing is going to get hit just as hard with a hard volatility increase as a butterfly is with a down move. And you need to be aware of that. The initial volatility hit is going to hurt. Again, if you withstand the initial volatility hit and you stay in the trade and the back month happens to come up, then the calendar will gain value and be more like what you have here with the butterfly. However, if that does not happen, then you're just out of luck. So that's the issue with doing with calendars. And the reason I'm mentioning this is because I got contacted by several new people this month who used calendars to hedge volatility, and they took devastating losses with their trades. And they're wondering why. And the reason is because the overall market volatility doesn't have very much to do with whether or not a calendar is a good trade. The thing that determines whether or not a calendar is a good trade is what the back month implied volatility is doing as compared to the front month volatility. So if we come back to our calendar, or let's go back to Wednesday here. Right, if we're back to Wednesday, and just let me delete these trades out of here. What we have at the money volatility of our September at 17.1. We have at the money volatility of October of 17.5. It's generally, or most of the time, your front month volatility is going to be lower than your back month volatility. in normal market conditions, typically that's what's going to happen. Sometimes it's a lot lower, sometimes it's the same, sometimes it's higher. But for the most part, it's usually a little lower. And that goes, each month you go back, your volatility tends to creep up a little bit. Now, what happens when you get a sharp down move, like if we go to the end of the day on Monday, if we take a look at the money volatility levels here, we have a 36% in September and 31% in October. Both volatilities went up significantly, but you can see the front month went up significantly higher than the back month, which is going to create a loss in the position. And it's the relationship between this volatility and this volatility that's going to determine whether a calendar is a good trade or not. In fact, on Monday, when the market came down, when people were freaking out because their calendars didn't make any money, I was looking at putting on calendar trades. And if we took this for an example and we put on 40 calendars at the money, this is actually a fantastic high probability trade. It's very, very unusual for us to have 36% in the front month and 31% in the back month. If you go back historically and you pay attention to such things, or you trade regularly and you just pay attention to these, you would know that. This puts us in a position where we're very, very likely to make money, even with a very big market bounce. So, if you take something like this and you put this on, now people are saying, the volatility's sky high. You got to be out of your mind to put on a calendar. Really? All right, fine. Well, let's go to, let me just look at the T-log because I actually did make an adjustment to this calendar on the 31st, but let's go to the 30th, right? So we'll let the little bit of time go. I'm sorry, let's go to the 28th here, right? These tend to even out. The volatility went way down. It was in the 30s. Now it's only 26.9 or 27 and about 29. So now there's only 2 points difference. There was 5, now there's only 2. Hence we had a bit of a gain here. Of course, the market did take off, especially if you look at, let's go Monday morning because I adjusted this Monday morning. Let's go, I think it was after 11. If we go to Monday, we did have some very large market moves. I guess we're not getting pricing here. We did have some very large market moves, but and we started to become more negative delta than I want it to be. So I just made I made an adjustment. It wasn't time to get out of it yet. Let me see if we have data the next half-hour period. We still don't have data, but I have. Oh yes, we do. So what I did is I just took 20 of these 1110s, brought them to 1130, flattened out our delta a little bit, and got into a position like this. But despite the fact that we had a very, very large up move off the bottoms, right? Because remember, I put it on a calendar here, right? This is a 60 point gain in a very short period of time, and I put it on a calendar when it was very high volatility. You would have assumed a volatility drop here, and we did get one. And you would assume that would have killed the calendar, but it didn't, right? The calendar's up decent money. And if you actually bring this to today, because the market pulled back again, we were looking at gains in the range of $16,000 to $17,000 on that's a fairly good sized trade, but you can see how that was, even with the extreme price movement, how that was kind of like a no-brainer trade, right? A calendar and very high volatility when I'm expecting the volatility to drop. So you can see the common wisdom behind calendars is kind of not there, right? So the big thing here is that you need to understand your trades. And the only reason I'm showing you this is because I'm frustrated seeing you guys, or traders in general, listen to these mentors or whoever they are spewing out theories in these classes about trading by the Greeks. I mean, education's great, but for your own sake, please verify the information. I mean, if I listened to these guys, I'd still be working on cars feeding money to the market gods, right? At some point in my education process, I had a lot of education with all these big education companies. At one point in the process, I said, hey, what they're teaching me isn't working. I'm going to go out and start verifying stuff. And I came up with stuff that worked. And I suggest to do the same thing and just verify all the information you get. Even if it's from me, I'm not asking you to take the stuff at face value. I just showed you an example. Go in and test this stuff for yourself. Don't just start trading a bunch of money and hope it works. This is your money and you're the one who needs to test the theories on your own so you can understand things like this that happen when you're live trading. So I guess my point here is stop listening to all these theories and hoping that they're right. Stop wondering how your trade is going to react in this environment and start testing how your trade actually reacts, because that's the only way you're going to have the confidence that you need to actually do the right thing with your trading. So am I afraid of the market? No, I'm not. I'm not afraid at all. I've been through this before. And my trades have been through this before, and I know that they do fine. And if I happen to run across something I haven't been through before, I can certainly find a similar environment and back trade it and see what I can expect. And like I said, my trades are great in these conditions, so I'm all in, as they say. And if you have a trading system that does well in high volatility environment, and you took a hit last month, and you're a little jumpy or afraid to get back into the market, what you need to do is you need to remember that it may not have been the size or the magnitude of the move that actually took you out. It was instead the extreme shift in market conditions. Now that it's happened, the shift has already occurred, your risk has dropped substantially, and it's time to get back in the game. And if you're still hesitant, just reduce your trading size. Because you got to remember that live trading these types of markets has extremely valuable lessons. And the only way you can get these lessons is to be in the market trading, right? And they're lessons that you definitely need to learn if you ever hope to become a full-time trader. Remember what happened a couple weeks ago over the last 2 weeks. This is going to happen again. It's not the first time it's happened. It won't be the last time. Next time it may be worse. We don't know. But however it is, now is the best time to get in the market, learn how to deal with it, so that when you go off on your own and you're depending on this income, you know what to do. So get back in the game and trade well. We'll talk to you soon. Bye.